Morning, everyone, and thank you very much for joining me. This is the DAX Open with myself, Russell Shaw. I'm a senior market specialist at FXCM, and my email address rshaw@fxcm.com. Today being Monday, the 17th of January. I'm just going to bring up our high risk investment warning. I'm going to keep this on screen for a few moments. And here's our market commentaries disclaimer. And here's our references, FXCM Market Scope 2.0. I'm going to go through the CNBC note separately. I want to keep it off screen. Just last time there was an advert for one of the competitors, and I just wasn't feeling comfortable I could upload that. So I'm just going to hopefully we'll just get same utility from me reading the article. It is on the CNBC website. And the headline reads, European markets head for higher open as investors digest Chinese growth data. European stocks are expected to open higher on Monday as global markets digest the latest growth data out of China. Markets in Europe and Asia Pacific will be digesting this gross domestic product data, with official data showing the world's second largest economy grew faster than expected between October and December. US markets are closed today because it is Martin Luther King Jr. Day. So there's certainly most likely going to be less liquidity in the market, so please be aware of that. Chinese shares rose Monday in a mixed trading session across the Asia Pacific, with the Shanghai composite adding 0.32%, and the Shenzhen component gained 0.89%. Numbers from China's National Bureau of Statistics showed the Chinese economy grew by 8.1% in 2021, slightly below the market expectation for around 8.4%. In the fourth quarter, Chinese GDP rose 4% from a year ago, topping a Reuters poll that predicted a 3.6% increase. Okay, so higher in the quarterly data, lower on the annual data. Economists were expecting Monday's data to underline a slowdown in growth, in part due to factors like China's strict measure to contain the Omicron COVID variant, as well as problems in its property sector and sluggish consumption. In Europe on Monday, investors will keep an eye on the latest Eurogroup meeting of finance ministers in Brussels. Data releases in Europe on Monday include Italy consumer price data for December and final inflation data for the Eurozone in December. All right, that's the end of the article. Let's bring up the chart. All right, I think let's start off with the difference. Oh, these are the same charts. Okay, let's just take a look at this weekly chart. Let's take this off. Let's just talk about these two candles. And when I say these two, I'm talking about last week's and the week before. So this candle, which is the third candle back, and then last week's the second candle back. And if we combine these two guys, well, you can see we've got a doji. Okay, so open and close look just about right. We may have a slightly lower close, but I think by and large, in the spirit of the candle, it's a long-legged doji. In other words, uncertainty. The bulls trying to push price up, they get repelled at the apex. The bears trying to push price down, they get repelled at the nadir, and effectively we are flat. So let's take this off. And I think the positive we can take out of last week's price action. The positive, because it was an uncertain week. Even if we don't combine those 2 weeks, you can see the candle by itself is an uncertain. But the positive, if we have to take positive out, it is the fact that we didn't close below the reference candle low. So if we use this as the reference candle, we would have condition 1. In other words, that would be the highest high in at least 3 candles. Would have condition 2. Price would be taking out the reference candles low. But we don't have condition 3, and without condition 3, you've got nothing, right? So you don't have a reference candle turning point here, which is bullish. Is bullish. So we're just going to have to watch how this week develops, but we're going to be really more conservative in terms of the prospect of a bearish correction. We're going to say, okay, look, we'll address the bears and we'll say, you guys didn't take price down to a point last week that showed bearish follow through. Because you didn't follow through last week, well, we're going to be stricter with you. You're going to have to prove to us that you're following through this week. In other words, they're going to have to take out last week's low. And that's a big ask from where price is right now. So at the moment, the fact that the bears didn't follow through, I think is an indictment on the bears. And it gives the bulls an opportunity here. Okay, so if we move the line in the sand from last week's low to last week's high, we can say we'll address the bulls and we'll say, okay, bulls, the bears didn't follow through last week. Are you able to follow through this week? And what we're looking for effectively is, so let me just get a more royal blue. What we're looking for is a close which gives us last week's candle as the lowest low in at least 3 candles. That's condition 1. Condition 2, price taking out last week's high. And condition 2, price closing above last week's high. Now, again, I don't know if that's what's going to happen, but this would be the bullish scenario. The bearish scenario, well, we'll need price to close below the low over here. So we sort of not really, we don't really have a indication. Is it going to be a bullish? Is it going to be a bearish close? We don't know. But what we can say is that the bears did not capitalize on the weak price last week. So that's an indictment against them. If we go through to our oscillator, so this is still the weekly chart. It's exactly the same price data, but just now we're adding oscillators. You can see that the stochastic's making its way through to the upper quintile. We're not there yet, but if we can get through to the upper quintile, I think that would be a bullish development, and it would be really good to see that if there is a bullish reference candle at the end of the week. So that's what we're looking for this week. It may not materialize. Nevertheless, I think at the start of the week, that's the sort of the measure, and we'll see how the market reacts to that. We can't really say much about this candle right now because we haven't had a European trading session. It's an inside candle, but let's be fair. We've had no European trade, and we've also got a significant public holiday in the States today, which is going to probably affect global liquidity, right? So we'll just keep an eye on that. Let's go down to the daily. All right, so the daily, again, in zone 2, it's the neutral area. It's not the ideal place for price to be. That, I think, matches up with the fact that we had a doji over the last 2 weeks when we combine these two. Okay, in other words, a long-legged doji I mean, it's a fancy name for really saying the market is completely uncertain. And I think that's very much reflected in zone 2 of our DAX. It's now just a matter of seeing as the week develops whether we can push back into zone 1. And if we go down to the hourly is actually looking pretty good. Okay, it's looking pretty good. So you can see that you've got a bullish crossover in the trend following indicators, and you can also see that the stochastic's making its way towards that 80. Now, let's just put everything together, and then we'll make an inference with regards to the hourly. But we must acknowledge that the weekly is uncertain at the moment. The only positive we can take out of that, is that the bears did not capitalize on the weakness. They didn't capitalize on this kind of let's call it a gravestone doji, but this is a bearish candle. Bears didn't capitalize on that. So the fact that the bears weren't able to capitalize on it, maybe that suggests that we're going to have a bullish reference candle, but that remains to be seen. That's very much confirmed by the fact that we're drifting in zone 2. So with all this kind of drift and uncertainty, now we go down to the hourly and we say, okay, we do have a bullish cross on our trend following indicators. We do have stochastic moving into the upper quintile. That's bullish in terms of momentum. Now it's up to the momentum to hold in this upper quintile. If we hold in that upper quintile and we develop that angle and separation over here, then I think we start pushing into zone 1, and then we start seeing a movement towards a possible bullish reference candle. We'll only know that at the end of the week. But of course, the week starting off with a good looking hourly chart, it guarantees nothing. Okay, in other words, we could hit the upper quintile and we can slip out of it just as quickly, and that's what happened here. Okay, so you can see let's put in an arrow. We had a movement into the upper quintile here. It was looking good, so we had a bullish crossover on the stochastic. We had a bullish crossover on the trend following indicators, but the momentum did not cooperate. It dropped. Okay, and of course, once your momentum drops, your price, is coming down. Because we know that because the stochastics derive from price, right? Now we're at a very similar type of situation where we are moving into this upper quintile, and it's all about now momentum. What about momentum cooperating? Let's just go back here, and when I say cooperating, something like this. If it hits that upper quintile and sticks around, okay, it sticks around. Well, that means that the momentum's in the top 20% of the range, and we should get some sort of push. But if it drops out, we're not going to get that sustained push, and we're going to have to accept that, understand the uncertainty continues, and plan our market activity based on that. Given the fact that there is uncertainty, everyone knows that trade must be with a stop loss. Depending on your trading style, perhaps a stop loss under S1. So, and this is please don't take this as advice. I'm just showing some thought process. This would be, so it's below price support and will be below pivot support. If somebody was going to choose that, you've got a stop loss of about so 135 points on the DAX. You'd use that to measure your exposure, and your exposure should be at most 2%, and that's coming out of Dr. Elder's The New Trading for a Living. Is probably too high, should probably be lower than that. So stop losses, money management, and the acknowledgement that we are in this uncertain environment, and then it's now all about the market cooperating, seeing if we can get this momentum going. And unfortunately, the liquidity is probably going to be thinner today than on a normal day because of the Martin Luther King Jr. Public holiday in the States. All right, any comments? Please go ahead and type those through. Any comments? Please go ahead and type those through. All right, nothing coming through. So I'm going to put this up on Insights, and there won't be a US Open today because of the public holiday there. So I'll speak with you guys tomorrow morning. Thanks very much, and appreciate you joining this morning. Thanks, guys.